Welcome everyone. My name is Nikki Johnston and I'm with Transition Advisors. Our webinar today is Admitting New Partners. Before we begin, we need to cover just a few important items. First, please close any other programs that you might have running on the computer right now. This will just help to ensure a quality presentation and reduce any audio issues. Transition Advisors LLC is a proud and approved sponsor on the National Registry of CPA Sponsors, per NASBA. Under the new NASBA guidelines, today's 60-minute session qualifies for 1.2 CPE credits. In order to receive the 1.2 credits, you must complete 2 requirements. The first is that you participate in all 4 of the polling questions throughout the presentation today. And please note that GoToWebinar does monitor your participation in these polls. We are able to give partial credit for those who answer 3 out of the 4 polls. That would be 1 CPE credit. Next, you must also complete an online evaluation. This will appear on your screen immediately at the end of the webinar, so please don't close your browser until you've had a chance to complete that survey. Once you've met both of the requirements, I will email your CPE certificate to you, and that will be within 10 business days. Now, in order to fully participate in the webinar, please take just a moment to familiarize yourself with that GoToWebinar control panel. You should see it on the right-hand side of your screen. There's an orange arrow near the top. You could use that to minimize the panel. During the presentation, all of the participants are muted, but you can communicate with us by using the question box toward the bottom of the panel. Just type in your question and click send. And time permitting, we will get to all of the questions during the session today. If not, we will follow up via email afterwards. Now finally, I'd like to remind you that Transition Advisors offers 2 free 1-hour CPE webinars each month. We have some upcoming topics there on the screen. Next week we have succession planning and valuing your firm. That's actually a 2 CPE session, so that'll last for 100 minutes. Also, we have preparing your firm for an upstream merger, the urge to merge, and for those of you that are in Florida or Georgia, we have a special session for those in the southeastern U.S. that takes place on November 10th. You can find a list of all of these and the additional January one that we have on our website. Just go to the CPE courses section of transitionadvisors.com. Now, as a reminder, you received a link in the email that you got from GoToWebinar yesterday and this morning that has the slides for you to download. I just sent it via the chat function as well, so if you'd like to download the PDF, you can. If you would like to receive that by email, just send me an email and I'd be happy to reply and attach that for you. You can reach me by replying to one of those reminders from GoToWebinar. Now I'd like to introduce our presenter for today. Terry Putney is the CEO of Transition Advisors. Thanks so much, and I hope you enjoy the webinar.
Thanks, Nikki. Just a little bit of information about us. We're a national consulting firm. We work only with accounting firms and only on issues related to ownership transition. That falls into 2 general categories. We do a lot of work with mergers and acquisitions, involving both finding the parties, whether you're a firm interested in growing through merger or acquisition, or a firm that's interested in potentially merging upstream or selling the firm. And then we also work with firms that have found their own party to the transaction and help support those deals through coaching and valuation and documentation and so forth. And then the other area, which is one we're focusing on today, is working primarily with internal succession, and that involves both helping firms understand and build a business plan for how to deal with the succession of their retiring partners, and then also admitting new partners, and then of course working on the structure of the owner agreement in order to facilitate and manage that. With that, we're going to go straight into a polling question so we get some idea of the nature of the audience that we have today. So Nikki, I'll turn it back to you for just a moment.
Okay, the polling question is up on the screen. How many equity partners do you have in your firm? I'll give everyone just a few seconds to answer this first one. Okay, looks like that's just about everyone. I'll go ahead and close the poll. The results are there on the screen. Fairly even split today, Terry. 32% are in that 2 to 4 range. 24% are either sole proprietor or 5 to 9, and then we have 20% in that 10 to 19. nobody in the 20 plus.
Okay, good. That's a good audience. So just briefly, today we're going to go through, we're going to deal with basically two general areas in our discussion. First, we're going to look at some basics, just review the basics of how owner agreements are structured, how valuations are typically done within the firm. And then we're going to look at the techniques for how to admit new owners using that owner agreement. So we'll dive in right now. When we start off talking about the basics of how most agreements work, most agreements were built primarily with the idea in mind of how do we buy out owners when they retire. However, how to bring in new owners is a completely different issue, and many agreements are not set up to address that very well, which probably is why many of you are on the phone. You have an owner agreement, and it's sort of like, well, I understand what happens when somebody leaves. I just don't understand how to bring somebody in. I find that oftentimes to be the case. When you look at the value of your accounting firm, it falls into two basic categories. One is what I call the tangible equity, which is primarily the accrual basis book value, and you look at it generally at the end of the year after you've made your distributions of that year's profits. What would your book value look like? And for most firms, that's going to be primarily driven by the value of the receivables and work in process. The other value, and the one that most of us focus on and makes up the majority of most of the value in most accounting firms, is the intangible value. That's what we primarily oftentimes associate with the client list or the revenues, fees of the firm. Of course, if you're into business valuations, you understand there's more intangibles than just the clients. You also have your workforce in place and the value of your brand and maybe special systems and so forth that you have. But the reality is that for most accounting firms, most of the intangible value is defined by the client list. So when we talk about a firm being worth 1 times, we're usually talking about the intangible value only, and the tangible value, the accrual basis book value, would normally be on top of that. So in valuing intangible equity, which is what most of what we're going to focus on today is about, there's generally 4 different methods that most firms, 1 of 4 methods that most firms use. Usually much small firms that are oftentimes just getting started often use a book of business method, which is a means of saying, look, I'm managing maybe $500,000 or $600,000 worth of business. You're managing $400,000 worth of business. If I leave, I should get paid for my book of business. If you leave, you should get paid for your book of business. And that's the way a lot of firms start off looking at valuations. Probably the most common method for smaller firms is the equity multiple, which is, we're going to get into that in detail here in a minute, but generally means I own X% of the firm is worth Y, and therefore I should be paid X times Y. The compensation multiple method is used by mostly larger firms and involves looking at the compensation that a partner makes, multiplying that times a multiple, which oftentimes falls in the range of 2 to 3 times, and that defines that partner's ownership of the intangible value of the firm. And we might pay that over, anywhere from, say, 8 to 15 years. The AAV method or unit method, we'll get into it at the end of this session, is a hybrid really of the equity method or the compensation method, and is a little more sophisticated, and it uses a different methodology for allocating the intangible value of the firm. And then of course there's other methods that are used, such as a fixed buyout amount or a fixed percentage of the firm's volume. When we look at the Rosenberg survey, which just came out, by the way, I highly recommend it. If you don't have it, I recommend that you obtain it. It has some excellent information in it. Based on the Rosenberg survey, of all the firms that have responded in the 2 to 4 partner range, which is the majority of the firms on this call, 28% use the multiple of equity method, and 30% use the multiple of compensation method, so about the same. 9% use a managed book of business, which I just described, and then an emerging trend is the 18% that use the AAV method, and about 15% use some other means of allocating value. When you look at larger firms, you see some more trends towards that multiple of compensation. So again, from the Rosenberg survey, much smaller percentage of firms with 13 or more partners would use the equity method. Surprisingly, some still use the managed book of business method at that level. But for the most part, the majority of firms are using the multiple of compensation method. And then again, this emerging trend of using the AAV method. What may be surprising to you, to a lot of firms that I work with at least, is what the average intangible value to revenue is based on the surveys. Because most of us have kind of grown up thinking that firms sell for 1 times revenues. And the reality is that still is a very popular metric for, or multiple for assessing value. Now this covers whether we're using the equity method or whether we're using the book of business method or even the compensation method. The response to this was trying to get an assessment of how much the intangible value in the firm is relative to the revenue of the firm. And as you can see, as little as 1 in 5 firms are still using 1 times revenue based on the Rosenberg survey, whereas roughly 70% of the firms are using something less than 1 times. We're definitely seeing a trend downward. I would say that of the larger firms, the top 50 firms in the country, that percentage is probably averaging somewhere around 60 to 70%. By the way, that's also driving, to a certain extent, the value that those firms are willing to pay in an acquisition. Oftentimes they're kind of matching up what they're doing internally with what they're willing to do externally. So that's why you see multiples in mergers and acquisitions coming down as well. In looking at the equity method, let's just take an example of how this works. This is the traditional method that most firms at least start with, and the same would apply in the book of business method. If rather than looking at the overall revenues of the firm, we'd be looking at the revenues of a managed book of business. So let's say we decide that the valuation multiple that we want to use is 85%. If the firm's value was, or revenues were $3 million, that intangible value would be $2,550,000. If the firm's accrual basis book value is $600,000, and that's a pretty common average, it runs between 20 and 25% of revenues typically in most firms. The total value of the firm would be $3,150,000, and if I own 30%, that means that my owner's value is $945,000, or 30% of the $3,150,000. On the other hand, if I'm using the compensation method and I'm making $300,000, which would be a reasonable amount of compensation for an average partner in a firm of $3 million who owns 30%, and I'm using a 2 times comp multiple, that means the intangible value that I've been assigned would be $750,000. If I own 30% of the equity and we allocate the accrual basis book value based on that, which is another common approach, then my tangible allocation is $180,000, and in this case, my total value is $930,000. Now, it's not really a coincidence that that's similar to the $945,000 in the previous example, because the compensation multiplier was historically another way of allocating the same value in a different manner throughout the firm. If you remember that in many firms, the profitability, partner profit, before any partner compensation runs about 1/3 of revenues. And if we're using 3 times multiple, which historically was the multiple when this method was originally invented, 3 times 33% is 100%. So it was meant to replicate the same valuation, overall valuation for the firm, and just allocate it in a different manner rather than allocating it based on an arbitrary amount of equity I might own. Is allocating it based on relative compensation. The compensation method really feels more like a retirement plan because it's compensation based. However, really it's just a different way of allocating value within the firm. You know, some other basic financial terms that you find in most agreements. First, the term of payment. Most agreements would pay the intangible value over 8 to 15 years. By far and away, the most popular is 10 years. So getting back to the example we used before, if my intangible value assigned to me is $750,000 under the compensation method, I would receive, oh my gosh, I'm sorry about this, people. I'm not sure what happened here. My intangible value would be paid at the rate of $75,000 a year for 10 years for $750,000. We're seeing a trend towards a longer payout periods in some cases, and I'm seeing more and more 15-year payouts in an effort to try to match up that payment period with the amortization of an intangible in cases where a firm has found a way to treat the buyout as a capital asset. You can do that in a partnership using Code Section 736B. So some firms are moving towards that approach and as a result are stretching out the payment periods. The tax treatments in most deals that we're involved in and see are to treat the payments as deductible as paid, oftentimes in the form of retirement payments. And again, in a partnership form, it would be under Section 736A. And or in a corporation, it would be in the form of deferred compensation. Again, in some cases, we're seeing firms move to methods that use capital gain treatment in order to create a better benefit for the recipient. One of the things that's surprising for some people is there's very seldom interest paid on top of the payments for the deferred payments. And the thing to keep in mind here is that even a 6% interest rate on a 10-year payout increases the overall payments by 33%. So if we're saying, well, I want to value the firm at 1 times, and not knowing that in most cases that's without any interest, and then I add 6% interest on, I'm actually valuing the firm at 1.3 times. So keep that in mind with respect to the terms that you use in your owner agreement. You know, when looking at the value that you use in your agreement, it's important to use external benchmarks as a guide, like the PCPS survey, which comes out every 4 years. The one for 2016 should be coming out soon. The IPA benchmarking report, which I'm going to refer to in just a little bit, the Rosenberg survey, which I've already used, and association surveys, and there's other surveys out there. It's important to understand how your firm's agreement compares to the marketplace so that you have some idea of whether or not it's reasonable. And it's very important to know that with respect to any merger or acquisition activity you're involved in, because a person who's evaluating your agreement against other firms' agreements is going to take that into account. But the real issue is the internal economics, and that should be the true goal of your assessment. So when looking at the terms of the agreement, you need to take into account the cash flow impact on the firm when somebody's being bought out. And the deal should always be self-funding, meaning that you should be able to pay for a retired partner's buyout from that retired partner's foregone compensation, while also taking into account the fact you need to replace that person and the cost of doing that, and also leaving something behind for the remaining partners, so there's an incentive to actually carry out the plan. I would recommend that if you want to get into the issues of how to structure your partnership agreement, that you refer to a webinar that I presented on August 11th. You can get to that on our website. We record all of our webinars, and you can view, or I'm not sure if you can download or just view the webinar on our website. That's at www.transitionadvisors.com, and go to the CPE tab and then look at past offerings, and you'll find that webinar for more information about what I just went through. With that, Nikki, I'm going to turn it back to you for a moment for another polling question.
Okay, the second polling question is on the screen. This one is, does your firm have an owner agreement? And you see that the options here are yes, and it's signed by all owners. Yes, but it's not signed by everyone. No, you need one. No, you aren't sure that you need one. And again, this is the second of 4 polling questions today. I'll give everyone just about 10 more seconds to cast their vote. Okay, we've got nearly everyone. I'll go ahead and close it. The results are on the screen. 61% do have an agreement, and it's signed by everyone. A quarter of the folks say no, they aren't sure that they need one. 11% indicated no, and they do believe they need one. And then the remaining 4% yes, but not all owners have signed it.
Okay. And the reason why you haven't signed it was probably because, based on my experience, either you really didn't agree on the terms or you've admitted some new partners and didn't ever have them sign it, which is, I'm guessing, probably more often the case. Hopefully, based on what we talk about today, you can figure out a way to do that, or if you need help with it, obviously we're here to help. Or if you need help with anything having to do with your owner agreement, even if it's not about admitting new partners. Okay, so, when most people think of selling an interest in an accounting firm when admitting a new owner, they sort of think of it like, well, the stock that I might own in my 401k plan. So I own, X percent of a company, and that company's worth Y. So my interest in the firm is worth X times Y. Or if I'm selling an interest, in the firm to somebody, they should pay X times Y. And that's where most of us start thinking about this, and that's where things start bogging down, because all of a sudden we realize, gee, that's a big number, and there becomes other issues associated with it, and it becomes difficult to understand how to do it, because that just doesn't, it makes sense, but I don't know how to make that actually work. So let me give you an example. We've got a firm that's a $3 million firm. We're going to use a valuation multiple of 100%. The total capital in the firm, or the accrual basis equity, is $600,000. So the total value that we're going to try to ascribe to the firm is $3.6 million. If I'm going to sell a new partner or 10% interest, that's $360,000. Where are they going to get $360,000? Well, I'll let them pay for the $360,000 over 5 years. So we're going to adjust their compensation by $72,000 a year for 5 years. Or maybe we do it over a longer period of time. But somehow we're going to have them pay $360,000. And even at the number that we're talking about here, that's a pretty big number. So the issues that we've got to address here, of course, are that overall cost to the new partners. New partners typically make between, based on the surveys, the IPA survey is the best one for this, make between $180,000 and $250,000. Now, of course, it could be anything in your firm, but that's kind of where the common range falls. Probably 80% of firms fall in that range, at least the firms that are on this call. That's about $40,000 to $90,000 more than a non-equity partner makes in that same survey. So it might be fair to estimate, based on that, and of course my experience tells me this as well, that the average bump in compensation that a new partner gets when being admitted to a firm, a new equity partner, is probably in that range of $40,000 to $90,000. Probably closer actually to 40 than it is to 90. Very rarely would it go up as much as 90. So if we're going to ask a partner to pay $72,000 per year out of compensation, and we've only given them a $40,000 increase, what's going to happen? Obviously, they're going to take a step back in compensation, which isn't really a very motivating premise. A lot of people would say, gee, I'm not sure I'm ready to sign up for that. So again, we still have this problem. So how do we get them their 10% interest? Because we're not going to give it away. So what are we going to do? And keep in mind also, now that we've asked this partner to make this significant investment, that's obviously going to go to the existing partners. How do you deal with acquiring more equity? When do we go from 10% to, let's say we've got 5 partners in the firm, we've got one partner owns 10%, the other partners own 18% on average more. How do we ever get from 10% to an equal percentage? When do you sell them more equity? And how do you consider, when you do that, the value that they may have helped create? Are they going to have to buy that? So when the firm started at $3 million, now while they're a partner, we grew to $5 million. Should we give them any credit for what they might have done to help us grow from $3 million to $5 million? How do we figure out what kind of return on investment they should get for the $360,000 that they invested? The conundrum is, what's fair to the selling partners or the senior partners in the firm? How do we make this affordable for the new partners without giving away all the value we've created over many years? So I'm sitting here in a firm I've helped build, and it's a $3 million firm, and that's got a significant value for me. I'm not willing to just give that away. And if I'm going to increase partner compensation so that they can afford it, if I'm going to increase it, going back to our example of $72,000 a year, if I'm going to increase their comp for $72,000, aren't I just really giving it away? Have they really invested that money? What's reasonable to expect from new partners? You know, if I'm going to make that kind of investment, that $360,000, shouldn't I have a significant return? And I'm not probably interested in making the same or less money to buy into this firm. So again, this conundrum of, you know, what's right for both sides of the agreement, even though we know we need to do this, can be difficult to overcome. You know, the benchmarks, again, from the this is from the IPA survey. In firms that are under $3 million, typically the average capital buy-in is only $71,000. And even in firms that are in excess of $20 million, which would be firms with more partners than most of the firms on this call have, it's only $116,000. The average overall is $102,000. So how do I get from this kind of average, of this average buy-in, to this need to acquire a significant stake in the firm? Well, if we go back again to the $3 million example that we used, and a 10% interest being sold, if we only limit, let's go back to do that, in fact. If we go back here, and if we limit the amount that we're asking them to pay in only to this $600,000 capital, I can sell them 10% of the firm for $60,000, and I'll meet these benchmarks. Now, how do I do that, though? Well, the thing to keep in mind is that we define the equity. Let me go back here. We define the equity, what equity means in the firm. So if I limit the amount of value that they've accumulated at that point in time to the $60,000 or the 10% of only the tangible equity that they've acquired, then it can make sense that I sold them a 10% interest in the firm for only $60,000. We're going to jump off here for a minute and do one more polling question, Nikki.
Okay, the polling question's on the screen. This one is, I believe our approach to valuing our owner's interest in the firm is, and here your options are fair and affordable. Fair, but you're not sure that you can afford the buyouts. Not fair because you think they're too rich. Not fair, you think they're too low. Or this question isn't relevant because you don't have an agreement. So we'll give everyone just a few more seconds. This is our third of 4 polling questions. And to get that 1.2 credits, you do need to answer all 4 of the polls. Okay, that's nearly everyone. I'll go ahead and close the poll, share the results. No one said it's not fair. So we've got a pretty even split between the others. 36% are in that not applicable, 36% say it's fair and affordable, and then the remaining 29% say they're fair, but they aren't sure that they could afford the buyout.
Okay. And if your agreement is set up properly, again, if you go back to that webinar that I gave on August 11th, you'll see if your agreement is set up properly, you should be able to afford it. So it's either, the problem is either that you haven't gone through the analysis that would demonstrate and support that notion, or oftentimes the real issue is, do I have people, the right people in place to actually do the, take over for the partners that are leaving? When I find that, well, I'm not sure we can afford it, it really comes down to, we really don't have a plan for how we're going to go forward once our senior partners leave. That can also be an issue. So I know I've left you hanging on how to answer the questions of the conundrum, and we are going to answer those. We're going to take a little bit of a detour here, and then we're going to come back to that, and I'm going to show you a method for overcoming those problems. So there are basically 2 criteria when deciding the timing of admitting new partners. The first one is our firm ready to admit new owners? And the second one, of course, is the candidates that I'm considering, are they ready? When assessing whether or not your firm is ready, we're usually primarily talking about capacity. We should try to avoid cutting the pie that represents partner compensation into too many pieces. That leads to, obviously, lower compensation than partners may find acceptable, and in the long run can be a real problem with retaining your best talent, your best partner talent. These are averages from the IPA benchmarking report. It doesn't mean because your firm isn't making this average or is making more than this, there's something wrong. It just gives you some idea of what the averages for firms your size are making in terms of partner profitability. So looking at, when assessing whether or not, what you really want to say is our target for our firm is this. This is what we hopefully can maintain. And therefore, if we have the luxury of doing this, that we're not going to admit new partners if we're going to have a significant dilution of our partner compensation pool. Another metric that comes into place is revenue per partner, which is probably the one that's most commonly used in mergers and acquisitions in trying to assess, what to do with the partners that are being acquired by the typically larger firm. How many partners can we bring in based on that firm's volume? And which partners can we bring in based on how much business they're managing? So in firms that are less than $3 million, the average according to the IPA report, and I think that probably for the smaller firms, the firms that respond to the IPA report are probably higher performing firms. So I think that's actually above average based on my experience, that $1 million. But again, frame of reference. You can see these metrics. The key thing is to try to understand what's right for your firm and trying to maintain discipline around how much volume you should have per partner and in assessing whether or not it's time, whether you have the capacity to admit new partners. And then the third metric you might want to consider is number of professionals per equity partner, and this is oftentimes referred to as leverage. This really defines, I think that the importance of the leverage metric is not only in terms of understanding capacity, but also it defines the role of a partner with respect to client service in your firm. The lower the ratio, the more involved partners tend to be directly in delivering client service. So if I'm on average managing 6 people in the firm compared to someone who's managing 3 people in the firm, it's likely that the person who's only managing 3 is doing a lot higher percentage of the client service themselves, which actually can affect certainly the partner's role in the firm, but also affect the client experience. So as you are changing, as that metric changes because you're adding more partners, you keep in mind that you're also probably modifying what it means to be an equity partner in your firm and what it means for the clients in terms of who they're actually interacting in your firm. So again, trying to maintain some discipline around what makes sense for your firm. I'm not saying these numbers are the right numbers, they're just averages. So in looking at whether or not your firm is ready to admit a new partner, a key issue is capacity, and this is 3 ways to look at capacity in your firm. But the other issue is sometimes the circumstances of your succession needs are going to override your operating metrics, meaning you've got partners that are, because you've got several partners that might be leaving in short order, and whether or not we've got the right metrics, we need to get people in place now to be ready to replace those people when they leave. So in doing that, it's important to go through an assessment that looks at both the need, how you replace the people who are going to leave and when they're going to leave. There's really 2 ways that you deal with the retirement and replacement of retiring partners. One is what I call, these are my terms, role reallocation. A role reallocation is where we say, look, we've got enough capacity within the firm now at the partner level. We don't need new partners to replace this person. It's probably because there's the person that's leaving doesn't have any special skills. That we have capacity within the existing partner group. We may have admitted new partners recently or something, and therefore we're not going to have to admit a new partner with respect to that individual partner's exit. The other is role succession, which is saying we need another body when this person leaves at the partner level. That can be because we don't have capacity within our partner group, or because this person has special expertise or has some special duties. But either way, we need to find someone to specifically, not necessarily replace, step into their shoes, step into their office, but we need to add another partner in order to deal with this person's retirement. So the way to use this concept is to go through and do this assessment. for your partner group. Look at your partners, and these are just categories I've come up with: 1 to 3 years, 4 to 7, and over 8, because 1 to 3 is pretty much immediate, 4 to 7 is intermediate, and over 8 is, well, I've got some time to deal with it. And look at all of your partners and decide, do we need to do a role reallocation, or can we do a role reallocation based on this person when they're planning to leave, or do we need more bodies? And of course, in this example, we're saying that the person that's leaving here in short order, we don't really need a new partner to replace that person. But for these two people, we do. The people that are leaving in the 4 to 7 range, we're going to need new bodies for that person, probably partly driven by the fact that some of our capacity is going to be soaked up with this person. And then looking out further, just as an example, one's a role reallocation, one's a role succession. So what does that mean? Well, you should give yourself probably at least 3 years ahead of these retirements. If this was going to happen in 5 years, we should have, if partner B was leaving in 5 years, we should have that person's replacement in place at least no later than 2 years from now. And why 3 years? Well, we need to have the person at the partner level who's kind of, finishing their development at that level in place for at least 1 to 2 years before they're really ready to take over the duties of a senior partner that's leaving. And then we need to give ourselves at least 2 years to go through the actual transition of transitioning client relationships and other duties within the firm. So the combination of those two is, at least a 3-year transition, if not 4. So in looking out, again, at the specifics, in this case, if this was 5 years out and this was 7 years out, this tells us we need to have partners in place, 2 years out and 4 years out in this example. So even though the metrics may not justify bringing those people in at this point, the need that the firm's going to have down the road because of succession will drive the need to do this. The second then issue is assessing whether or not the partner candidate is ready. Too often what I find is the firms are shooting from the hip on assessing candidate readiness. We all sit around the table and, we talk about Sally, and Sally is, 3 people think Sally's ready, 3 people think she'll never be ready, should never be considered, and, somebody says, well, I'm not sure. And we're really not talking about anything specific that we can use in the assessment to try to overcome that. So what I recommend is that you have something like this, which is a generic characteristics of a partner. This is actually used by something similar to this is used by many firms around the country, and this in essence becomes a job description. Now it's not the kind of job description that your HR department would call a job description. This is more a qualitative analysis, but we can use this for several things. One is to assess a candidate's readiness. So if we go through and say, why isn't Sally ready? What are the things that Sally's missing that are on this list? And then the second thing that's even more important is we can use this to train and develop Sally to overcome those shortcomings. So if Sally has, really good personal productivity, and Sally has actually a really good following of clients, but Sally's, pretty bad at staff development, and Sally hasn't done anything to get involved in the community, and she's not very good at communication, quite frankly, then those are things that we can hopefully address in her development plan to say, Sally, we really want you to be able to overcome these issues so that we can look at, you becoming a partner in the firm, and these are the things you're falling short on. And then we can tailor her training or CPE or on-the-job training or mentoring around the things that she needs in order to, become truly a partner in the firm. This is I think our last polling question.
It is. This is our fourth and final question. This one is, does your firm have adequate talent on the bench to replace retiring partners? And here your options are yes, and you're confident the approach works. You think you do, but you aren't sure how to admit them. No, you don't have the talent you need, or you're not planning to pursue internal succession. We'll give everyone just a few more seconds. Okay, nearly everyone has voted. I'll go ahead and close the poll now. Here we've got 39% saying no, they do not have the talent they need. 26% yes, and they're confident. 23% think that they do, but aren't sure how to admit them. And then the remaining 13% say they aren't planning to pursue internal succession.
Okay. So, unlike Mr. Trump last night in the debate, I'm not going to leave you in suspense any longer. So we're going to talk about, I hope that was taken with a tongue-in-cheek, I'm going to talk about what you can do to overcome the conundrum that we talked about earlier today. This approach is one that I'm using increasingly, which is the AAV and unit system in owner agreements, because it works so well with respect to admitting new partners. What we do is we separate the intangible value from the tangible value, which we've already talked about. And we only sell or ask the new partner to invest in the tangible value. That's all we ask them to make an upfront investment in. So using that example we used before, the $3 million firm with the $3.6 million overall value, we would ask them only to make an investment of $60,000. We could do that over 5 years at $12,000 a year. It doesn't have a major impact on their compensation. It doesn't require us to give them a huge increase in compensation in order to afford it. It gives them probably some decent upside with respect to their compensation as soon as they become a partner. So, but we express the intangible value in the form of units, which is tied to the volume of the firm. So we're getting into the specifics of that in a minute. New partners are not required to buy units up front. They're not required, in essence, to acquire any intangible value up front. They may sometimes be awarded a small allocation in recognition of their prior efforts. Maybe they've brought in $100,000 or $200,000 worth of business over the years, and we might give them some or all of that in the form of units. New partners, but they earn their unit allocations through participating in executing a business plan for two things: participating in the firm's growth or helping the firm grow, and by being part of the team that is buying out retired partners. So the upfront investment is limited to tangible value, but they accumulate their tangible value. They accumulate the intangible value over a long period of time by executing the business plan the firm has for the succession of its partners and for growth, and basically through sweat equity. So here's an example of how this works. We've got a $3 million firm. We establish 1 unit per dollar of volume, and we update that every year. So if the next year the firm's $3.2 million, we add 200,000 more units. In this example, as we started off at this point in time when the new partner comes in, however we got there, partner A owned $1.2 million of the units, partner B $1 million, partner C 800,000. The new partner had no units assigned to them at the beginning of this example, because they were just admitted as a partner. 2 years later, the firm's grown by 600,000. So we've established 600,000 new units. Now in this example, just to make it easy, I allocated that 600,000 equally at 150,000 units per partner. It doesn't have to be that way. I'm finding that oftentimes a senior partner, for instance, who might be nearing retirement, may have no new units assigned to them. A new partner might have an extraordinary amount of units assigned to them based on growth in an effort to try to bring them closer to parity. Or we might assign the units based on performance evaluations. We might assign the units based on new business development. You can do it any way you want. It gives you the total flexibility, and you can do it differently from year to year. That's one of the advantages of this system, because it's a totally flexible system in terms of these units aren't really anything other than just numbers on a spreadsheet at this point. In this example, we don't have to value the units at $1 per unit, even though the units were established on that basis. We can value the units at 90 cents per unit. That's in essence saying that we're going to value the firm at 90% of its revenues. So in the example again, 3 years later, partner A retires. And when they retired, I've left out a comment here, I'm sorry. When they retired, they were, let's go back. the firm had, the partner A had 1,350,000 units. 90% of that is 1,215,000 for his 135,000 units. So the total value of partner A's buyout is $1,215,000. And we're going to pay for that over 10 years at the rate of $121,500 for each year. Partner B has now accumulated that same $1,150,000, and as we buy partner A's units at the rate of $135,000 per year, we're going to allocate those units back into the existing partner pool. Again, it doesn't have to come in equally. It can come in any way you want. You can deal with it the same way you deal with the growth units. But you can see now how the new partner is going to start accumulating intangible value through the execution of those two components of the business plan. One is to spur growth, and the other is to be part of the team that's buying out existing partners. So over time, needless to say, a new partner is going to accumulate a lot more value. On top of that, the other issue to take into account with respect to new partners are vesting programs. Now, the unit system sort of has almost a built-in kind of vesting to it. But when we talk about vesting, and it's really important that you use a vesting program with respect to a compensation-based model, because there's no buy-in on compensation-based models for intangible value. So when we talk about why do we use a vesting program, well, the point is we're not trying to say we own the partner. We're not trying to say, gee, I own you for the rest of your career, therefore you can't go anywhere. What we're really trying to say is we want to avoid creating an incentive for a new partner, for younger partners to leave before the plan is fully executed. The plan being the buyout and transition of senior partners. That's the only way the firm can sustain itself, is if we have the people in place to take over for the people that are leaving. So that what we're really doing is creating a disincentive for them to leave early. It works especially well in compensation-based systems, as I said, because typically in those systems there's no buy-in other than the capital. So you almost have to have a vesting program. And it promotes the retention of the succession team. And it also allows for a lot more flexibility on the initial buy-in, because you're not worried about somebody cashing in their chips early for something they may have been given that you may feel like they haven't earned yet. So an example of how vesting works is typically we would say that anything that they bought in, and obviously that would be the tangible equity in the examples I've used for the most part, they would be fully vested in at the time they're admitted as a new partner. In the example, if you went back to the original example I showed you with a $3 million buy-in with $360,000 investment, excuse me, you'd have to vest that person in their ownership because they paid for it. It wouldn't be fair not to. Another disadvantage of using that approach. Typically, the intangible value that we use would vest 50% after 10 years, with the remaining being vested over the next 5 to 10 years. So if we used a 20-year fully vested program, then we would use 5% a year for the next 10 years. And obviously, if we use 15 years, we'd do 10% a year for the next 10 years, or next 5 years. The other thing we oftentimes do is include an age vesting component. So typically, in most firms, mandatory retirement ages now run between age 65 and 67. You probably want to give somebody a window. I don't think it's a good idea to have a mandatory retirement age of 65 and you're not fully vested till 65. I think it's better to have a little bit of flexibility on that. So oftentimes we're looking at a fully vesting being at age 60 or 62 with partial vesting at age 55. That's a pretty common approach. And again, you use the same technique that you use for tenure vesting. For tenure vesting. And what we oftentimes do then is we use the lower of the two. So we look at the tenure vesting, which is how long you've been at the firm, whatever percentage that comes out to be, and look at the age vesting, whatever percentage that comes out to be, and the lesser of the two is the vesting that applies to that particular partner. Let's see. Some additional information that you might refer to. You can download these articles from our website. How to admit new partners, a fresh new approach, goes into a more detailed analysis of the AAV or unit approach that I just went through. It also compares it to the compensation method and shows the advantage of one versus the other. One thing I kind of neglected to point out was one of those differences. I was talking to a firm just actually this morning. This was a small two-partner firm, about $1.5 million in volume, and the two partners were making about $300,000 each. They're looking at their long-term succession needs, and they're looking at admitting 2 new owners to the firm. So let's assume that they did that, and we were using the compensation method. Well, at the point in time when these 2 new owners were admitted, if we were using a 3 times comp multiple, which would value the firm at $1.8 million, so let's say we used a 2.5 times comp, which would value the firm at $1.5 million. Then the 300,000 times 2 times comp, or 2.5 times comp, is $750 each. But after we admit these new partners, let's say that they're making at that point in time down the road $250 each. Now all of a sudden we've gone from allocating all the value in the firm to the original senior partners, so now we've diluted their value by almost 50%. So they'd be out, if they were at $350 at that point, and each of the other 2 partners were at $250, 7/12 of the value would be in the senior partner's hands, and 5/12 would be in the younger partner's hands. And there wouldn't be any way that the younger partners would have paid for that that value that they've accrued. So you can see there's a huge disadvantage between the unit or AAV or the compensation method versus the unit method in terms of how we allocate value and how value is accumulated by younger partners. So again, I'd recommend this article, How to Admit New Partners, a Fresh New Approach. Another one is Planning and Paying for Partner Retirement, which was also a Journal of Accountants article from 2012. Again, you can download it from our website. We wrote a series of 12 articles, 12 months in a row for the Journal of Accountancy on succession issues. It covers everything having to do with succession, merger and acquisition, partner agreements, selling your firm, valuing the firm, and so forth. And then we also wrote, immediately following that, at the end of 2014, a 3-article series strictly on valuing CPA firms. The first one was on, I believe, small firm valuations, the second on large firm valuations, and the third was on internal valuations. Another area that I'd recommend you access is the AICPA Succession Planning Resource Center. We did have an input on this. We didn't provide all the information in it, but quite a bit of it. This is my partner down here, a picture of him, and that's a screenshot of the first page. So it would help you with a lot of tools on how to deal with succession in your firm. Finally, I'm a member of the CPA Consultants Alliance. You can see the other members of that alliance here. There's, I think, 12 of us, no, 13 of us. And we have written a book, which is you can get on Amazon, which is called Bridging the Gap. And then we've also published 3 white papers on leadership and generational cultural differences and succession challenges. And you can download those white papers from our website at cpaconsultantsalliance.com, and also subscribe to our blogs and so forth at that website. With that, I appreciate your attendance, and if you have any questions about what we've talked about today, feel free to send me an email. I'd be happy to answer your questions. Nikki, I don't think we got any in the chat box, did we?
No, we don't have any questions in the chat box today.
Okay. So, but if something comes up, feel free to send me an email. And Nikki, I'll turn it back to you to wrap this up.
Okay, great. Thanks so much, Terry. Terry mentioned a few articles on our website, and you'll get an email in about an hour or so from GoToWebinar that has links to all of those. And he also mentioned that we've got recorded sessions from our previous webinars. You can watch those at any time. We can't offer CPE for those, but you can access those on our website in the archive section. Don't forget, when I end the webinar today, before you close your browser, take a moment to complete the survey that'll pop up. That's the other requirement that you need to complete in order to receive your credit. So if you have any questions about the content, you can reach Terry at that information there. If you have any questions about your CPE credit or registration or finding something on our website, feel free to reply to any of those emails from GoToWebinar and they'll reach me. With that, thank you all so much for attending, and I hope you enjoyed the webinar.